Welcome to the Opening Bell Report.
Okay, so I want to start today with a scenario. And to be honest, it sounds a little bit like a scam.
Uh-oh. I'm already hooked.
Right. So
Okay.
imagine this. I walk up to you, I open up a wallet, and I show you $1,200 inside. Real, crisp, verified cash.
Okay.
And I offer to sell you that wallet with all the cash for $500 right then and there. What's your immediate reaction?
My immediate reaction is I'm looking for the hidden camera. Or I'm assuming the bills are fake or something.
Yeah.
You just don't buy money for 50 cents on the dollar. That kind of trade just doesn't exist.
Exactly. Our brains are just wired to think that markets are, efficient, that there's no such thing as a free lunch. But according to this research we're digging into today, that exact scenario is playing out right now on the stock market.
It is. It sounds absolutely insane, but we're looking at this really comprehensive equity research report. It's dated February 17th, 2026. And it's all about a company called Strive Inc., ticker symbol ASST.
And the math in this report is, well, it's kind of shocking in its simplicity. It suggests that because of this perfect storm of corporate confusion and mergers, this company is trading at less than half the value of the assets it actually holds.
And we should be clear about the stakes. This isn't some vague, undervalued claim.
Yeah.
The report is very direct.
Oh, it's direct. It slaps a strong buy recommendation right on the table. The price target is $30.
And the stock is currently trading around, what, $8.30?
Yeah, about that. So that's an implied upside of, my math isn't great, but it's something like 260%.
It's huge. But look, we're not here to hype a stock. We're here to figure out why this dislocation exists. We need to unpack this newly completed merger between Strive and Semler Scientific and really answer the big question.
Which is this the arbitrage opportunity of a lifetime, or is there some kind of trap door we're not seeing? I'm always the one looking for the trap door. So let's start with the transformation. If you looked up Strive Inc. a year ago, you wouldn't have found a financial powerhouse. You would have found, what was it, a marketing firm.
Yeah, and a pretty niche one. Before all this, Strive was basically a company called ASST Entities, and they were a microcap digital marketing firm. They did things like manage Discord communities, run TikTok campaigns for Gen Z.
Chat rooms and dancing videos, not exactly Wall Street.
Not at all. And this is really the first key insight for you. You have to completely delete that old version of the company from your head. The report says the legacy revenue, which is about $1.5 million a year, is now, quote, irrelevant.
Irrelevant is a really strong word for a part of the business that's actually making money.
It is, but in this context, it's accurate. Strive has gone through a complete identity transplant. When they completed the merger with Semler Scientific, they became a Bitcoin treasury company. They absorbed Semler's entire balance sheet.
Right, so Semler comes into the picture, and they weren't a marketing firm, they were in the medical space, but they got famous for something else.
Bitcoin. Semler was one of those few public companies that really went all in on the Bitcoin standard early on. So when Strive merged with them, they got the whole treasury.
Which was how much?
Specifically, they acquired roughly 5,048 Bitcoin.
Wow, just in one signature.
And it gets bigger because when you combine that with what Strive already had, the total holding is now approximately 12,798 Bitcoin.
Nearly 13,000 Bitcoin. I can't even visualize that. Where does that put them globally?
This is the context that I think people are missing. That stash of coins makes Strive Inc. the 11th largest corporate holder of Bitcoin on the entire planet.
11th.
11th. They are holding more Bitcoin than Tesla,
Yeah.
more than Trump Media.
Yeah.
They are sitting at the table with giants, but they're still trading under the ticker of a penny stock marketing firm.
That is a wild disconnect. The balance sheet of a fortress with the stock ticker of a meme.
That's the friction right there. The market is struggling to reconcile Discord moderators with 11th largest Bitcoin holder. And in that confusion, the price gets suppressed.
Okay, let's get into the boring math you mentioned. This is the valuation gap section. Walk us through these numbers because this is the part that made me read the page 3 times.
This is the absolute core of the thesis. Everything else is just noise. It all comes down to net asset value, or NAV. So we know they have about 12,800 Bitcoin. The report assumes a Bitcoin price of around $95,000.
Okay, a fair baseline.
Right. So simple math, 12,800 times 95K. That gives you a Bitcoin treasury worth approximately $1.2 billion.
1.2 billion with a B, liquid assets, sitting there, not some future revenue projection.
Correct. Now, let's look at the company's price tag, the market capitalization. The stock market says the entire company is worth about $518 million.
Wait, just pause there. I want to make sure I heard that right. You're telling me there's a vault with $1.2 billion inside it, and the market is selling the key to that vault for about $500 million.
That is the math. Strive is trading at roughly 0.45 times its net asset value.
So Less than 50 cents on the dollar.
Less than half. When you buy the stock at $8 and change, you are mathematically acquiring the underlying Bitcoin for a 50+% discount.
That feels broken. I mean, usually if a company holds $1 billion in cash, it's worth at least $1 billion. Is there a massive debt load we don't know about? Is that the trap door?
That's the critical question. A company isn't just its assets. Strive did inherit some debt from Semler. There's about $120 million in convertible notes on the books.
Okay, so that's the catch.
Well, it's a factor, but it doesn't close the gap. Let's do the math again.
Right.
Even if you subtract that entire debt load right off the top, the asset value drops from $1.2 billion to about $1.1 billion.
And the market cap is still $500 million.
You're still looking at a more than 2x gap. The debt explains a tiny fraction of the discount, not the whole thing.
So even with the debt, you're buying a dollar for, what, 55, 60 cents?
The arbitrage is still massive.
But then why isn't it priced like MicroStrategy? I look at Michael Saylor's company, MSTR, and it's the total opposite. People pay a huge premium for that stock.
And that's what the report calls the Saylor premium. MSTR often trades at 2 times its NAV. People pay $2 for every $1 of Bitcoin MicroStrategy actually owns.
Which honestly also sounds irrational, just in the other direction. Why pay double?
Because you're not just buying the coin, you're buying the machine. You're paying for Saylor's strategy, his ability to issue debt, buy more Bitcoin, and grow the per-share value. It's an active play.
So is Strive just a passive wallet, or are they trying to build a machine too?
Oh, they're absolutely building the machine. The report is clear that they're adopting the exact same leverage and accumulate playbook. But here's where it gets really interesting. They might actually have an advantage MicroStrategy didn't have at the start.
And what's that?
The flywheel effect from Semler Scientific. Remember, Semler wasn't just a shell company holding Bitcoin. They have a real profitable medical business.
Right, the vascular testing stuff, the heart monitors. I kind of assumed that was just baggage they'd sell off.
Nope, it's the engine. That medical business generates reliable cash flow, millions of dollars. Strive can take that cash and funnel it directly into buying more Bitcoin.
Ah, I get it. So MicroStrategy has to sell stock or issue debt to buy more coin. Strive can do that too, but they also have a day job that pays them in cash they can convert.
Exactly. It's a diversified revenue stream. It de-risks everything. If you go to a bank and say, I want to borrow money to buy crypto, they might get nervous.
But if you say, I have a profitable medical supply business with steady cash flow,
The bank opens the door much wider. It improves their credit worthiness, lets them borrow cheaper, and buy more. That's the flywheel.
So if they're copying the playbook and they have this extra engine, why is the market still punishing them? Why isn't the stock at $16, which would just be parity?
And that brings us to the psychology of the discount. The report identifies 3 main reasons for this, and none of them have to do with the quality of their Bitcoin.
Is it just that people don't know what's happened yet?
That's a big part of it. Reason 1 is just complexity. Think about the timeline. You had Vivek Ramaswamy founding Strive, then it merges with this penny stock asset entities, then they immediately announce the Semler deal, then they change the ticker.
It's a corporate identity crisis.
It's a mess for algorithms and databases, which often lag. If a fund screener still lists Strive under marketing, a Bitcoin fund will never even see it. It just falls through the cracks.
Okay, so the computers are confused. What's reason 2?
The reverse split. This is a big one. On February 6th, Strive did a 1-for-20 reverse split.
Oof. Yeah, I know how retail investors see those. A reverse split usually means a company is about to get delisted. It's a sign of desperation.
Exactly. 90% of the time, it's a dying company trying to keep its share price above $1 to stay on the NASDAQ. So when people see that, they sell first and ask questions later. It creates a mechanical price drop.
So Strive got caught in that.
They did, but the report argues this was an offensive move, not a defensive one.
How is a reverse split offensive?
They didn't do it to survive. They did it to qualify. By pushing the price up from, say, 40 cents to over $8, they unlocked what you could call the velvet rope.
The velvet rope.
The institutional mandate. Most big funds, pension funds, ETFs, they have charters that literally forbid them from buying stocks that trade under $5. It's considered a penny stock.
Ah. So as long as the stock was at 40 cents, the big money couldn't touch it, even if they loved the math.
They were locked out. By forcing the price over $5, Strive made themselves buyable for Wall Street. They took that short-term hit to gain long-term access to serious capital.
That is actually really clever. What's the third reason for the discount?
Short interest. The haters.
Is it high?
It's over 25%, which is incredibly high.
But why would anyone short a company that's trading at half its cash value? That sounds like a suicide mission.
The shorts probably piled in during all the merger chaos. They saw a small marketing firm doing complex M&A. They saw the reverse split, and they just bet on failure.
But the deal didn't fail. It's done.
It's done. The Bitcoin is in the wallet. So now those shorts are trapped. They're shorting a company that has a hard floor under its price, the value of its assets.
And to get out of their short position, they have to buy the stock.
A classic short squeeze setup. The report points to this as a major catalyst. You have this massive fundamental valuation gap and a ton of people betting against it who might be forced to buy back in. It's a powder keg.
Okay, so let's talk about the technical setup. If I pull up the chart today, what am I seeing?
You're seeing the aftermath of that split. The stock dropped, yes, but look where it stopped falling. It found a hard floor around $7.57.
It bounced there.
It refused to go lower. That usually tells you that informed buyers are stepping in. That's accumulation. Now it's back up to around $8.30.
So the bleeding stopped.
The technicals suggest a reversal is in play. The report points to a really specific breakout zone. If the stock can clear $9.20.
$9.20, that's the magic number.
That's the key resistance level. If it breaks through that, the report says there's clear air all the way up to $12. There are very few sellers layered in between.
And even at $12, let's just remind everyone,
You are still buying the Bitcoin at a discount. You don't even need the Semler premium to see a huge return here. You just need the market to become rational.
and this doesn't even factor in the biggest variable of all, which is the price of Bitcoin itself.
Exactly. Strive is now a high beta play on crypto.
Explain what high beta means in this context.
It's basically leveraged exposure. Because Strive's market cap is so small compared to its huge Bitcoin holdings, its stock price should move more, percentage-wise, than Bitcoin does.
So if Bitcoin goes up 10%?
Strive's assets jump by over $100 million. But the stock might jump 20 or 30% as that discount narrows. The report estimates that for every $10,000 move in Bitcoin, Strive adds about $128 million to its intrinsic value.
So it's like getting leveraged exposure, but without the risk of a margin call.
That's a great way to put it. You get the Bitcoin performance, plus the closing of the valuation gap, plus the potential for a premium re-rating down the line. It's 3 ways to win.
Okay, let's pull back. We've painted a very, very rosy picture. What's the bear case? What could actually go wrong here?
That's the necessary question. The biggest risk is always execution. Mergers are messy. Trying to integrate Semler's medical business with Strive's legacy team while also managing a billion-dollar treasury is complex. If management fumbles, the flywheel breaks.
And the debt.
The debt is manageable now. But if Bitcoin were to crash, really crash, back to 40,000 or something, that leverage cuts both ways. The assets shrink, but the debt stays the same.
So it's not a savings account. It's a high conviction bet on Bitcoin and on management's ability to execute.
Absolutely. But the argument is that at this price, at $8, the market has already priced in total failure. The risk-reward is heavily skewed to the upside.
You're paying for failure and getting the potential for success for free.
That's the very definition of deep value.
It just brings me back to that wallet on the street. It feels like we're all just staring at it, scared to pick it up because it has to be a trick.
And while we're staring, the institutions are slowly waking up. The reverse split got them past the velvet rope. The databases are updating. The shorts are starting to sweat. That window to buy $1 for 50 cents is closing.
It just challenges that whole efficient market theory we're taught. You'd think computers would fix this in a millisecond.
And they usually do. But when you layer on human complexity, name changes, splits, mergers, the computers get confused. And in that confusion, that's where you find the edge.
So the final takeaway from this deep dive?
The report says strong buy. The math is undeniable. The only thing really saying stay away is that fear of the unknown.
And usually by the time the unknown becomes known,
The opportunity's already gone. The stock's at $30.
well, I know what I'll be watching as soon as we're done here. Pulling up the chart for ASST. It is going to be a fascinating couple of weeks.
It's one of the most interesting setups I've seen in a long time.
Thanks for walking us through the madness. And for you listening, keep your eyes open. Sometimes those wallets on the street are real.
Don't forget to like, share, and subscribe for more.